As it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see.
The key variable for the months ahead is going to be unemployment. Even if we see a slower growth, we see the labor market will remain strong. And that is the key variable to predict asset quality in the coming quarter. So we are not that pessimistic about the evolution of asset quality in Europe.
We certainly are seeing continued inflationary pressures on our cost of goods. However, a business like ours, we have multiple levers that help us to handle the inflation. We are very surgical and careful on how much pricing we take and where.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in for Francine Lacqua here in London. Here is what is coming up on today's programme. The Fed delivers. The FOMC hikes 75 basis points as expected, with Jay Powell signalling flexibility in deciding how steep future increases will need to be.
We think it's time to just go to a meeting-by-meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
More tech torment. Meta slides post-market after its first ever revenue decline, while Samsung profit misses on muted chip demand. Attention now turns to Apple and Amazon. Plus, shelling out. The oil giant posts another record profit and announces a $6 billion buyback for the third quarter. Welcome to Bloomberg Surveillance, everybody. Welcome to the early edition. Let's have a look at where we are on the markets for you right now. This is post-Fed, in the midst of an earnings deluge, of course. We've got European equity markets up by 0.4%, but some of the markets in the mix turning a little more negative as we go through the hour, as we've been through the first hour of trading here in Europe. So the Stock 600 up by 0.4%. The FTSE actually, though, just dipping into negative territory. The CAC 40 up by 0.4%. The DAX and the IBEX are a little weaker. This is where we are on various assets for you. And just to show you what's happening in the US, which is important to do because we saw a real strength to the NASDAQ yesterday, up by 4%, but we are expecting to see some of that pull back a little. The futures picture down by 0.7%. We rallied a lot on revised expectations, renewed expectations of a pivot from the Fed. Is that premature? A conversation we will have a number of times in this hour. The Brent crude price, 107 is the handle there, continues to get that sort of risk-on bid, and also that's playing into the earnings story we're seeing here. And also iron ore included here as well, up by 6.5%. There is this China story around whether we'll see further support or at least recovery in the housing market there, and iron ore seems to be rallying on that and the broader risk-on momentum. So that's what we see across these markets. Let's have a look at the map, shall we, and to put that into some sort of geographical context. You'll see some of the areas of red that I just mentioned. So the FTSE, the IBEX and the DAX then just into negative territory. The IBEX in particular down by 1.4%. So we do have real divergence actually coming through on the performance of different European equity markets. Let's get to the various stock stories that are in focus. We've got so many earnings for you, but we thought we'd home in on 6 that have sent their share prices moving quite considerably, or at least are huge stories. So Santander down by 3%. That's certainly weighing on the Spanish market. We're waiting later to hear details around taxation on banks and on energy companies in Spain. But Santander down despite lots of numbers beating estimates, but there are questions over Brazil. Barclays, numbers beating at the investment bank, the FIC business doing well, the net interest income coming in ahead of estimates, but the cost pressures weighing on the business, in particular conduct and litigation charges. And so that stock down 2.5%. Nestle down by 1.6%. Again, here, passing on costs and guiding revenues higher, but there are questions around the margin. And also we've had such good news from that sector in terms of pricing power. Maybe some of that work has been done. Let's have a look at the upside, though. Shell up by 2%, a second quarter of record profits coming through from the oil major, better than estimated numbers, a buyback of $6 billion. Volkswagen up by 2.8% in the auto space, better than estimated numbers. Once again there, sales recovery at the end of the second quarter, that bodes well for running into the rest of the year, although they do have interesting things to say. In fact, the whole sector has interesting things to say about supply chains. We'll have more on that on Stellantis later. And Diageo up by 0.6%, just moving over there. Sales better than estimate in all regions. So it seems that just like we saw in the LVMH numbers, spirits doing pretty well right now. Now, we're joined with analysis on the earnings picture. We'll get to the Fed story a little bit later on. We're joined by Geraldine Sundstrom, Portfolio Manager for Asset Allocation Strategies at PIMCO. Geraldine, thanks so much for joining us. It's been such a busy day in terms of the earnings story. I don't know if it's shifted your narrative at all. Coming into today, the conclusion I was hearing from Bloomberg Intelligence was that we were getting lots of beats on the top line, but further down the P&L, things look more troubled. What's been your assessment so far?
We see the earnings season as really a mixed bag, and it's not necessarily very good news looking forward because we have an economic momentum that is decelerating very fast, and we also have central banks all around the world hiking interest rates. So we feel that we're likely to see more earnings revision downward, especially given what's priced for the second half of this year. And then looking at multiples, I would say we're not out of the woods. The market is around 17, 18 times for the S&P 500. And with the Fed hiking interest rates, with a high probability of recession on the horizon, that might look a little bit on the high side.
Yeah, and energy, such a big portion of many of these global markets, certainly here in London, certainly in Europe, broadly, Geraldine. Do you think that what we see in energy is sort of skewing our assessment of how the earnings picture is presenting itself?
Absolutely. I mean, there's two parts on the spectrum. There's energy on the one side, and we know there's financial on the other side. The average is a small single-digit number, but a lot of diversification and things going on under the bonnet. But then even within sectors, we see companies that have been able to pass on prices increase that are doing better than those that have failed. But, you know, we have to take a bit of a more medium-term view on all of this, because from one quarter to one quarter, things can change. And we think that where you need to really focus on those resilient sectors that will grow no matter what as the global economy slows down.
And Geraldine, where do you put technology in the mix? Clearly, technology is such a beaten-up sector, but a lot of people say just because it's cheap, you know, that's not enough. And a lot will depend perhaps on your assumptions around the Fed. We'll get to the Fed shortly, but where do you see tech moving?
Well, we think that tech has suffered a lot. Of course, there's one part that's very linked to consumer discretionary, which has suffered enormously. But when we look at valuation and we look at the secular underpin of a lot of these companies, they are starting to look attractive, especially in the hardware like semiconductors, where we're still seeing very good results, where we see, you know, lots more robotization, electrification of the world that will require a lot more semiconductors. So we think that this one could be attractive. So, you know, it's a question of looking for those companies with attractive valuation and very resilient balance sheet.
Yeah, with that in mind, I mean, we don't seem to be able to make enough chips for the purposes we want to employ them right now, Geraldine. Just looking at some of the numbers like Stellantis saying they're going to see chip shortages continuing to the end of the year. How much opportunity is there to scale up chip production then, do you think?
Well, we think that things are going to eventually get better. The shortages of chips are improving. But at the same time, we know that our economy and all the devices that are surrounding us, and especially electrification and moving to electric vehicles and a number of these applications, mean that the quantity of semiconductors we're needing are going to multiply, you know, in a biblical fashion. So this means that those companies have very good years ahead of them. There is, of course, a downturn in the cycle, but it's not to say that pricing power or the edge that they have and the concentration of the industry is not going to be a good omen for them going forward. And let's not forget, we also just had the Senate in the US passing on the chip bill, which will be a lot more subsidy for the industry and a lot more support.
Okay, so a lot more, so it's certainly a focus sector. Have you taken anything away from the earnings stories that you've been paying attention to, Geraldine, around inflation and our expectations for where that goes? Certainly in the consumer side, there seems to have been a message coming through that the consumer products, that these companies still have pricing power.
Well, the key issue there is really the companies with high inventories versus those that don't have the high inventories, and the pricing power also, depending if you're a high-end consumer product or low-end consumer product. These are pretty well-known, standardized pattern. That said, they are all very unclear about the second half in general. Very few companies give very firm guidance or very optimistic guidance. The silver lining in all of this is that wages are still good, and the employment situation is still good. But of course, in the fourth quarter, especially in Europe, household will have to contend with much higher energy bill, and we will see the true effect of the conflict in Europe and the price on gas and oil will have towards the autumn-winter.
Geraldine, thank you. Stay with us. Geraldine Sundstrom, Portfolio Manager for Asset Allocation Strategies at PIMCO, joining us there from Geneva. She stays with us. More on the Fed shortly. Let's take a look at some of the things to watch out for today. At just a few minutes, in just a few minutes, at 10 a.m. UK time. So that is actually more than a few minutes, isn't it? It's 50 minutes from now, so I don't confuse you all. We'll get the latest confidence surveys for the euro area. Then at 1 p.m, we will have the German CPI reading for July. We're getting some of the component parts, which are starting to build, interestingly, from different regions of Germany. Quickly followed at 1:30 p.m. by some data from the United States, including initial jobless claims, it being Thursday, and those GDP figures. Will we be in a technical recession? And then later, earnings season continues with Apple and Amazon in focus from the tech sector. Also Intel, with what Geraldine was just saying in mind, and Pfizer reports also. Some of the big names stateside that are due to report then for you. Coming up, we will focus back in on the US. The US economy is not in a recession. That was the message from Fed Chair Jay Powell as he signaled that more hikes are coming. This is Bloomberg. Welcome back. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Let's turn then to the Fed and its bumper 75 bips hike. Chair Jay Powell offered further guidance.
We're strongly committed to returning inflation to our 2% objective. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. We think it's time to just go to a meeting-by-meeting basis and not provide, the kind of clear guidance that we had provided on the way to neutral.
The Fed's Jerome Powell there. Now, Geraldine Sundstrom still with us, Portfolio Manager for Asset Allocation Strategies at PIMCO. Geraldine, give us your thoughts then post-Fed. So ongoing increases to come, but more flexibility in the coming months. Have you changed your view at all after last night?
Not really. I think what we're seeing is a Fed that is more relaxed. They reached the neutral stance expeditiously, and now they're going to take it meeting by meeting. They still need a moderately restrictive stance, and therefore they are not entirely finished. And the one thing that Jay Powell has pointed us to was the June SEP, which would mean another 100 basis points of hike by the end of the year. The issue between the market pricing and what the Fed has been telling us comes from for 2023. The market is already looking at cuts pretty early into 2023 when the SEP from the Fed would point to further increase in interest rates. And so the gap looking at the end of 2023 is around 100 basis points, which is quite significant. So the Fed will be taking it meeting by meeting, and we will depend on inflation. That's really what's going to happen.
OK, so in the near term then, do you think that the market needs to adjust to reflect what the Fed is saying? Or do you think the market holds its ground, confident that the Fed will return to its view?
I suppose the market has confidence. It's been leading the Fed so far in the last few quarters, and still sticks to its gun, at least with the price action we've had so far. Now, of course, we'll have to look at inflation, and if it slows down sufficiently, inflation is going to slow down, but will that be sufficient to ensure that the 2% target is in line? There are things that are looking good, like agricultural prices, oil prices. But on the other hand, we know that measures around wages or rents and shelter tend to be a lot stickier. So it's going to be like a push and pull around inflation. And maybe the market is a little fast in thinking that inflation is going to fall to an extent that will allow the Fed to cut interest rates so fast.
And a lot of the conversation, no doubt, will turn to where we're seeing areas of weakness, and we'll get the GDP data later on today, Geraldine. What are your expectations there, or perhaps more importantly, how significant do you think this data is going to be in shaping future thinking? Because, you know, you can make arguments that this is a technical recession then if we get another negative quarter, or you can say, well, no, just as we heard from Jay Powell, and we're likely to hear from the NBER, say this doesn't seem like a recession because it's not broad-based, because it doesn't include the labour market.
That's very true. We don't think we are necessarily right now in a recession, but the momentum is slowing down, and therefore the probability of recession is rising dramatically as we speak. So I think the Fed is going to look at many things. Of course, the GDP number is going to be very important, in particular looking at consumption pattern, but also at investments. You know, inventories or trade balance and things like this are less likely to be a big impact for the Fed. And then, of course, on Friday, we'll get payroll, we'll get the employment cost index and things like this, which are the other side of inflation, which will be critically important. So very data dependent now for the market, and really looking at every measure around employment, consumption, and also inflation.
OK, that'll be interesting then. We'll focus in on the payroll story on Friday, as the Fed has told us it's data dependent, and this is something that stands between the economy and recession. Geraldine, thank you very much. Geraldine Sundstrom, Portfolio Manager for Asset Allocation Strategies at PIMCO. Thanks for joining us. Let's get a Bloomberg First Words news update. Top stories we're covering here at Bloomberg. Here's Leanne Gerrans. Good morning, Leanne.
Hi, Anna. Democrats in the US have struck a deal with holdout Senator Joe Manchin on tax, energy and a climate bill, breaking a deadlock on legislation to enact major parts of President Biden's agenda. The plan raises some $740 billion in revenue over the next decade, with more than $430 billion in spending, and the rest to reduce the deficit. Now, Gazprom has cut natural gas supplies to the EU via the Nord Stream pipeline to about 20% of the route's capacity. That was yesterday. The Russian company says the pipeline needs 5 functioning turbines to run at full capacity, but only one is currently in working condition. Natural gas prices are more than 10 times higher than their usual level for this time of year. And the US Senate has agreed $52 billion in grants and incentives for domestic chip manufacturing. The vote comes after more than a year of debate and marks a major victory for President Joe Biden, whose agenda has largely stalled in the Senate. The legislation is a bid to strengthen US national security interests against future supply chain disruptions. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Leanne, thank you very much. Coming up, Meta missed, and for the first quarter ever, their sales declined. We'll talk tech earnings. That's in focus next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Anna Edwards in for Francine Lacqua in London. Let's focus in on big tech earnings. Meta Platforms, the social media giant that includes Facebook, Instagram and WhatsApp, reported its first ever quarterly sales decline, citing advertisers' shrinking budgets. To combat the slump, the company has tried to rein in costs by slowing hiring. Let us get to Matt Bloxham, who joins us now from Bloomberg Intelligence, and he can talk to us about what we take away from Meta and then help us look ahead. What were the big conclusions?
Yes, I think they talked about shrinking budgets. I think it's probably more that budgets are shifting to other platforms, so particularly TikTok. I think Meta themselves said that they're struggling with their own rival to TikTok, which is called Reels, and getting advertisers to spend against that. And they've also suffered more than most from the ad tracking changes that Apple made, which they'd already flagged last year there would be about a $10 billion headwind for them. So I think, yeah, more about budget shifting rather than shrinking.
Yeah, that's interesting because when we got those numbers from Snap, we didn't know which it would be. Was it going to be across all advertising, or was it going to be something that's just ad spend moving from one place to another? So that's interesting. Looking ahead then, we get Apple and we get Amazon. Let's talk about Apple. What do we focus
Apple,
on?
two contrasting stories there. Products and services. So products is iPhones, iPads, all that stuff. So about three-quarters of revenue. That's probably going to shrink, partly due to currency, partly just due to softer demand. Services, about a quarter of revenue. That's things like Apple TV Plus. That's growing at a rapid rate, so that's going to be the kind of the offset, if you like, to that pressure on their hardware.
Okay.
Amazon, it's three stories. They've got their e-commerce business, which is under pressure.
Yeah.
You've kind of seen those headwinds from Walmart, for example. But then they've got positive offsets from cloud and from advertising.
Okay, so three things to watch there. Thanks so much, Matt. Matt Bloxham giving you your briefing you need on tech from Bloomberg Intelligence. Coming up, we will hear from the airline sector, Etihad CEO. This is Bloomberg. The Fed delivers. The FOMC hikes 75 basis points as expected, with Jay Powell signalling flexibility in deciding how steep future increases will need to be. More tech torment. Meta slides post-market after its first ever revenue decline, while Samsung profit misses on muted chip demand. Attention now turns to Apple and to Amazon. Plus, shelling out. The oil giant posts another record profit and announces a $6 billion buyback for the third quarter. Good morning, everybody. Welcome to Bloomberg Surveillance. This is the early edition. I'm Anna Edwards in for Francine Lacqua here in London. We've had lots of companies reporting today. Let's get you up to date with a few more of these stories because we've got some big moves here on European corporates. Let's start with the hotel sector and Accor. We're going to be speaking to the management of Accor shortly, and that stock down by 7.4%. The profit forecasts came in below estimates, so we'll ask the business about why that is the case. Airbus down by 4.8%. They've cut their delivery target, taking it down by around 20 aircraft versus the estimate. Supply chain issues hitting their popular narrow-body aircraft. And Vestas, this, of course, in the turbine business, this in wind power business, and this company sees its share prices surging by 12%. And this is actually typical of across the sector because we saw the US passing that energy bill. Solar stocks are surging. Solar and wind stocks are surging as a result of that. Now, it is earnings galore today with some big names from the worlds of banking, food, drinks and autos all reporting. In total, across the globe, we have companies worth a whopping $9.4 trillion reporting today alone. Let us stick with the earnings story. Etihad Airways posted a record-breaking core operating profit of $296 million for the first half of 2022, despite surging fuel costs and some continuing confusion around travel in a world pulling itself out of lockdown. Let us get to this conversation. Manus Krani is with us in Abu Dhabi, and he is waiting with a special guest. Manus.
Anna, a very good morning to you. Yes, we're at Etihad HQ. Tony Douglas is the CEO, roaring out of COVID, roaring to a record first half profit. Good morning, Tony. Welcome to the show. You christened revenge tourism when you were with me the last time. The numbers speak for themselves. There's a record. Are we going to see full revenge tourism through to the end of this calendar year?
Manus, really appreciate you coming in to share this moment with us this morning. You're right, record numbers for Etihad. This has been 5 years in the making through a transformation program. So for us to be able to post $700 million positive EBITDA, $300 million positive core operating profit is a really important punctuation mark on this journey. And it represents, in the first half of this year, an average of a 75% load factor. But interestingly, the last 2 weeks, we've been in the low 90s, which in aviation speak, were absolutely full. So revenge tourism, it's real.
It's real. You got to get it to 95, 96% to win the trophy. What's the toughest call now as the CEO here? Scale up and add real volume to the fleet, or do you just hold your nerve and go, man, China is not open yet? So where are you?
So I think it's building upon the last point, get onto Etihad.com immediately. And the reason why I say that again, is for August, we are fully booked. For most of September, we're fully booked. So the momentum's building on revenge tourism. And therefore, without China coming online, we're already getting to the stage where our capacity is being fully utilised.
But if China comes back online, and I know it's going to be tepid, first flight in 2 years, have you got the ability to switch on the tap immediately for capacity?
So the important part about this transformation programme was to make sure that what we didn't have was a fleet that was driving the network was commercially driving the fleet. So what we've got now is a high-class problem. The first time we've had a situation like this where the market's coming back strong. What we'll do is we'll build in a very controlled way additional capacity, but only where it's profitable.
Cost of living crisis, I talk to every CEO about inflation. Are we at a crunch point? I have been fleeced on 4 out of the 5 flights that I've had in 15 days, right? I'm at a paying threshold. Customers must be at a paying threshold on prices with the cost of living. Are you seeing any of that yet?
You should have been flying on Etihad, Manus, that's for sure. But I guess, look, the reality is ticket yields are actually holding up. So we're seeing that across the marketplace. Cargo yields are holding up as well. And that's 2 of the principal reasons why we've been able to post such solid numbers. Off the back of 2 years where, frankly, we didn't have any revenues to speak of from passengers, it's the reason why now, for us, it's about building going forward, because pricing will, of course, ease off for sure.
OK, so you're full to the brim through to the end of September. London, Frankfurt, Paris, these airports have airline problems and airport problems. They are in crisis. You don't have strikes, well, certainly not in this country, but you must have pinch points as well. Let's start, first of all, where's the biggest issue for you? Hiring pilots, hiring staff, getting planes. Which is the pinch point at Etihad?
So I think, as you rightly say, we don't have a problem at Abu Dhabi International Airport, but we are at the moment suffering with our guest experience at many of the European airports, some of the ones that you've already mentioned. And sadly, I can't see that rectifying itself anytime soon. The pandemic, for many of them, it was easy to scale down. Many of these airports are finding it a lot more difficult to scale back up again. But going forward, actually, the point we were discussing slightly earlier, for us, the biggest pinch point is going to be taking more new deliveries from Boeing on 787 Dreamliner and taking the next batch of deliveries on the incredible Airbus A350 to take advantage when China comes off.
We'll get to that in a moment. So your problem about adding routes into London, Gatwick or Heathrow or Frankfurt is that they just can't take any more from you. That's the blockage?
So we actually don't have that problem, to be fair, with any of the European airports. It's more about getting the service standard in terms of on-time performance and guest experience in the European airports. Let's face it, who wants to stand in a queue for an hour and a half? It's simply not good enough.
Are you in full Monty hiring mode?
Simple answer is yes. We've hired over 1,000 new joiners to the Etihad family in recent months. And earlier this week, when I was down in our training centre, I have to share with everybody the absolute energy and excitement to see new people going through training to start a career, a journey in commercial aviation.
Well, that's grand, but are you paying them substantially more money than you did before the pandemic? Are wages up 5%, 10%? What is the uplift to the business in terms of cost?
The simple reality is we're seeing inflation everywhere. It's not really impacting us with the cabin crew and in terms of direct labour in this part of the world. But where we are seeing super inflation is through the aircraft component supply chain. And that's something that's challenging all airlines at the moment.
And that has got a consequence as well when you go to add capacity. I want to circle back to what could happen here. We've got the World Cup coming up. You can invite me later to the box. But are you going to add a super set of shuttles like they've got down the road? Are you going to fly the flag for Abu Dhabi in terms of adding a huge capacity for World Cup?
So the simple answer is yes, we're going to be putting 6 a day minimum on in terms of World Cup shuttle services. But I guess it links to a broader point.
Yeah.
You know, we've been doing a whole bunch of things differently as a result of the pandemic. So we're, of course, a network carrier. But what we do now is we put, for example, summer specials on. So this year we're flying to Nice for the summer. We're flying to Santorini. We're flying to Crete, Malaga and Zanzibar. You wouldn't have seen an Etihad do that in the past. It's about giving the travelling public what they want in an exciting way, but of course making sure that it's commercially viable.
Can you just do one to Mykonos, preferably on the 17th of September? But we'll talk about that afterwards. Where is the biggest cost? You're in a transformation, you say, but you're keeping a lid on costs. 50 million bucks came out in costs. How tight are you on that?
So cost is the trick to it. So if you track us back over this 5-year journey, that's been the most important thing to get under real control. And when the market came back is the key component to giving us the profits at the moment. The thing that's exercising every airline's chief executive at the moment is oil price, because of course that's the single biggest cost in terms of fuel. And at the moment, there's probably risk in that going forward as well.
How hedged are you?
We're in good shape in terms of hedging, in terms of previous years. We've been able to unwind some of it this year that's taken some of the edge off the surge in oil price. Obviously, we're not going in and hedging at the moment because in our view, the price is already too high.
And in terms of next year, Tony, if I sit down with you, where's going to be the strongest route that adds the biggest punch to that plane?
So I think that will be dependent upon whether China reopens. If it doesn't, it's still going to be London Heathrow. It's still going to be the JFKs. But in anticipation of China reopening, Shanghai and Beijing will be the ones to keep your eye on.
Business class, let's round off with this. Is it full to the max?
Our business class cabin has never been more full in the history of this airline. And I go back, $700 million EBITDA, $300 million core operating profit. A big part of that was out the business cabin.
Grant, well, don't worry, I'll complain to Sir Tim because I can't spend my miles there. Tony Douglas, always great to be welcomed into HQ. We'll see you soon. Keep flying the flag for Abu Dhabi. Tony Douglas, the CEO of Etihad, delivering, it seems, on all fronts, but just not hedging at the moment. Anna, Tom, good morning.
Manus, thank you very much. Very entertaining interview. I wonder how many of those business class travellers are actually on business, though. That's a big question. Coming up on this programme, we'll go through, it's like a travel special here on Bloomberg Surveillance, the early edition today. Let's land the plane and look to hotels. We will discuss Accor's second quarter earnings with the CEO, Sébastien Bazin. He joins us shortly. That is up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards, in for Francine Lacqua in London. Now, a year that began with tailwinds for travel as consumers took revenge on lockdowns by booking trips is now being marred by headwinds from airport chaos. So what does all that mean for hotels? Shares in France's Accor have slumped this morning after its full-year profit guidance missed estimates. Let's talk about this. Joining us now, Sébastien Bazin, the chairman and CEO of Accor. Really great to have you on the programme, Sébastien. Thank you so much for coming to talk to us. So let's start with the market's response to your earnings. Is the market missing something? The market seems to have taken a quite negative interpretation of what you put forward today.
Well, it's never a good thing when the CEO is saying that the market is missing something. That means the CEO has done a lousy job. So what I can tell you is we probably don't have the same definition. We have guidance for the market, which was, I think, 570 million-ish. And we've been saying this morning that we're going to do better than 550. Basically mean that I guess we're probably going to be reaching the 570 or better. So I think it's a question of semantic.
Yes, because the numbers I had in front of me say that you are suggesting EBITDA above 550 and the estimate was 571. Right, so you plus, okay. Okay, so you think there is...
It's going to be superior. We said it's going to be better than 550. So in today's world, I think it was actually probably better than anybody expected. And yes, I'm going to make sure we're going to be beating consensus.
Okay. Let me ask you about the chaos we've seen in other parts of the travel sector. things no doubt look peaceful and calm and restful at Accor hotels, but they don't look that way when you see images of airports. Is all of that putting people off traveling at all?
Well, it is probably, but it is not that impactful for us because we have the great benefit that I guess we never had before of a very, very significant domestic traveler business. And a lot of it actually people are coming from cars, from train, from the neighborhood countries. So yes, and the international travelers, even though they may wait probably a couple hours longer at the airport, I can tell you, go to Paris, go to London, go to Rome, it's full of international tourism. So I'm sorry for the pain, but when they go through the pain, they enjoy a very nice experience while they stay in the Accor hotels. So I wish we can actually ease the process, but it's fine. We're not being impacted by it at all.
Okay, we've seen a lot of we've seen a lot of strength in the US dollar recently, Sebastian. Is that resulting, do you think, in more American travelers going further afield, perhaps coming to Europe and other areas of your global operation?
Yes, it is. We've never seen so many American travelers and tourism here in France, and certainly in the south of France. So they do take benefit of actually a better currency. But this is, at the time they probably scheduled their travel, they did not know of that currency advantage. So it's not the reason why they travel, but it could actually increase the pace of it.
Okay, so something to watch in the future. More broadly then, how are bookings and occupancy rates looking for the summer? Can you update us on that?
Yes, it looks very, very strong. I think we're going to have probably the best summer we ever had in the history of this company. We had a very good months of May or June with positive RevPAR, which is basically better pricing that we ever had for the last 50 years of this company. And we said it double-digit, be it in Dubai, being in Sydney, being in Paris, being in London, even probably more than 20% in Dubai. So the summer looks very, very strong. And what is even more encouraging is the fall, autumn looks also very strong and different mix of travelers, because that is mainly seminar, congress, events. So the business travelers, where the summer will be the leisure travel. But I did not expect a so robust summer and so robust, basically, months of October, November, December. So yeah, Accor is back. Hospitality is back. Accor is back. And it's true all over the brand and all over the territories, which, again, was a bit unexpected. So it's faster, stronger, and all across the globe.
Okay, so those are some important comparisons then, and you say Accor is back. You've mentioned some of the travel trends that you've seen, a little bit more people arriving by train and by car, not necessarily flying, so maybe coming from closer places. What are the other travel trends that you're seeing at this point?
Anna, there's one which is we never had before, which is, again, of very great nature, because those are loyal customer, repeat customer base. Those people traveling for 4 days, they leave their home on Thursday midday. They stay with us until Tuesday morning. They work remotely on that Friday and that Monday. So my Sunday night is busy as it's ever been. So it's called staycation now. And it's usually 3 hours away from their home. So they actually do visit their own country, or they go from Nice and they go to Italy. But those are very much recurring, loyal, and they don't go through intermediaries like the OTAs. So it's a better revenue base. And again, people actually discovering places around them that they never thought about discovering. Why? Because they're mixing business activity, ability to work remotely with great Wi-Fi from the Accor hotel on that Friday and Monday, and returning back to the offices on Tuesday. That business, I think, will stay for a long, long time.
Okay, so that's a new development. I don't think it works in my line of business, but if you install a TV studio, then maybe we can, Sebastian. You're very positive then. It doesn't sound as if you're seeing any early signs of recession weighing on either Europe or your global business.
No, there's two things I'm worried about. One is the labor shortage. I wish we can have actually everybody back at Accor, and we're still missing 10 or 12% of the workforce, and we do everything for people to come back. We're being able to retain those who are still here. And the second thing, which we have to be very cautious about, is the level of inflation. Of course, we have some double-digit inflationary cost, be it IT sector or different tools of Accor, that we have the ability to pass through a lot of it through pricing today. But we are into a fairly fragile geopolitical, economical environment. That being said, under those circumstances, I can tell you, I've never seen so much of a greater force in people eagerness to travel, eagerness to actually spend more. And Accor is really responding with the best ever experiences for those who do travel, and with the best brands, probably in industry. So yes, I am far more optimistic than what the market reads this morning.
Okay, very optimistic then. You mentioned labour issues, and that is something I wanted to ask you about. You've said previously that the company is missing 10 to 15% of the staff that you had before. Is the sector just going to have to pay more to attract people from either not working or from other industries?
Anna, we've done it. We've been increasing the very low-paid salary by 12 to 15%, which is why we've been retaining most of them. It's not a question of pay, unfortunately. It's a question of sacrifices on people having to accept to, spend overnight, to work late at night, to sacrifice weekends. And a lot of people, you said it yourself, a lot of people are choosing another industry where they have the ability to work remotely. In a hotel, you cannot work remotely. So we need to basically to probably seduce the younger generation for them to accept those sacrifices. My instinct, or what I think the solution might be, that people will come back and work in the hotel industry only 2 or 3 days a week and not what it used to be 5 days a week. You do accept those sacrifices if you do it only on Sunday, Monday, Tuesday, and then you work for another industry the rest of the week. That's likely to be the solution.
Really great to speak to you. Thanks so much for talking to us today. We appreciate it. Sébastien Bazin, the chairman and CEO of Accor. Coming up on this programme, the oil giant Shell posts a second consecutive record-breaking quarter. We spoke to the CEO, Ben van Beurden, about the year so far. That conversation, we will bring you more of it next. This is Bloomberg.
What I do see, particularly in Europe, of course, with the very, very high gas prices that we are experiencing at the moment, we see a lot of LNG being bid away from Asia into Europe. But of course, there is limited supply coming on extra. So there I would see an accelerated transition away from gas into renewables. But that is not something that will happen in a matter of a few quarters. That will take a little bit longer. In the meantime, I think the fundamentals for LNG will remain very, very buoyant for years to come. The energy markets are tight and will remain tight and volatile, I think, not only for the remainder of this year, but also well into next year. Where will it go from here? Let's see. But I'm quite optimistic, both on the energy system as well as the global economy.
That was the Shell CEO, Ben van Beurden, on their back-to-back record-breaking quarters. Let's get to some of the stocks that are on the move substantially today. And let's start with Accor. We just spoke to the CEO of the hotel business. The stock down by 7.5%, actually paring losses just a little bit as we talked to the CEO. He was talking about, so the profit forecast did seem to be perhaps lower than the market had expected, but the CEO saying it shouldn't have been taken that way by the market, that the guidance isn't less than had been the estimate. He also said there's never been so many Americans in the south of France, so it seems as if the strong dollar may continue to encourage more flow in that regard. We've also got Airbus down by 5.7%, cutting their delivery targets, supply chain issues weighing on their popular narrow-body aircraft, and Vestas up by 12.3%. We've seen the US energy bill, that agreement passing, and so as a result, wind and solar stocks are really surging here in Europe, a thing we will pick up in the next programme. Now, Bloomberg Surveillance early edition continues in the next hour. I'm here in London, Kailey Leinz in New York. With Kriti Gupta today, Matt Miller is off. We will regroup and bring you the early edition shortly. This is Bloomberg.
I think Powell made it clear today that they think that they've reached an important point where monetary policy now is broadly neutral.
Catch-up phase and the phase of getting to neutral is over, and we're in a new phase.
He may not have accomplished as much as he was hoping.
It's a Fed that needs to re-anchor itself, but the real economy is again running ahead of it.
The Fed can't calibrate. They don't have the precision to calibrate the next recession. They can't just say it's going to be a mild recession and all is done. And their worst nightmare is hitting that tripwire.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Fed Chair Jerome Powell signals that more interest rate hikes are on the way, but he's not giving any specific guidance and says the pace of tightening will slow at some point. From big tech to big oil, investors have a lot of earnings reports to consider. Meta disappoints, Shell sets another record, and we'll hear from Apple and Amazon today. And a surprise deal on Capitol Hill. Leading Senate Democrats agree on a tax, energy and climate plan that enacts major parts of President Biden's agenda. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And we seem to have so many earnings, it's hard to keep up here in Europe. I know that this continues through the US session and into next week, but the big overarching theme for markets causing us to rally, at least in the short term, Kailey, has been the Fed.
Yeah, that decision and Chairman Powell press conference yesterday perceived as dovish by the market. The question is, was it really? Of course, we also have to pay attention to those earnings stories, as well as some breaking headlines we are just getting out of the Asian region, one including China's Politburo is calling for stabilizing the property market, which of course continues to be in turmoil. This is according to the Xinhua news agency. And also China vowing to strive for the, quote, best outcome for second half economic growth. Of course, the growth seen in the first half puts that 5.5% goal looking like it's pretty out of reach. Now, of course, those headlines crossing after the Asian equity session was over, but it was a positive one overall following the gains we saw in the U.S. yesterday off the back of that Fed decision. The MSCI Asia Pacific Index up about 1%, and you saw across asset classes really a bit into the bond market as well as those expectations of aggressive rate hikes from central banks get pulled back a bit. In New Zealand, the two-year yield down 11 basis points. While it is a broadly weaker dollar story across really all of G10 today, the far and away outperformer actually the Japanese yen, which right now trading around 135.36, is at its strongest level of the month so far. And finally, checking on iron ore as well, you have commodities broadly getting a lift on the idea that the Fed may take things slower from here, but also that property sector expectation that China will be boosting support for that sector, lifting the idea of iron ore demand. So those futures up for a fifth day in a row, up more than 6% overnight, now trading just shy of $120 a ton, Kriti.
Yeah, Kailey, I think what stands out to me is that weaker dollar story, because when you think weaker dollar, at least a year to date, that correlation has been very strong with the stock markets. A weaker dollar, stronger stocks. But today, that is not the case. You mentioned the weaker dollar. Take a look what futures are doing. They're down about 0.4%. This makes sense. Remember, yesterday we had a almost over 4% rally in the NASDAQ alone, over 2% in the S&P 500. So it's only natural to pair some gains the next day. But take a look what the 10-year yield is doing. The answer is not much for our radio audience. Even crude, it's kind of bouncing up to close to $100 level, 99 handle on NYMEX crude. Once again, nothing really to write home about. But Bitcoin here, it's interesting. You see it up about 0.9% at the same time that the stock market is actually lower. Anna, there are quite a few cross currents here. No clear narrative just yet in the U.S. session.
Right, absolutely. And the longer we trade here in Europe, the less clarity you get here as well, Kriti. We've got the European equity market pretty evenly divided right now, not going anywhere in a hurry. We had started out in more positive territory, but as we see that picture on the US futures, that puts a lid on our optimism, I suppose. Another thing putting a lid on optimism is some of the data coming out of the euro area. Economic confidence slumping to the lowest since February 2021. So you add that into what we've seen on the earnings stories, which do look pretty mixed and pretty divergent, and it is a mixed picture for Europe. You can see that Spain is really underperforming today, and we're waiting to hear later about taxes on big oil and big banking, and that is something we'll talk more about a little bit later. I've got a lot of earnings to talk about today, so I thought I'd put them all here on this graphic about how Europe is doing, because some of them are really interesting and could have read across into other US stories later. So Airbus down by nearly 6% today. They brought down their guidance as to how many aircraft they will deliver, just by 20, but that matters when you make big things like aircraft, of course. This in particular on the narrow body side. Barclays, the big bank here in London, down by 1.4%. They managed to beat on a lot of metrics, but a concern around cost, litigation and conduct costs in particular is weighing on the business. Shell up by 1.4%, a second quarter in a row of record profits coming through from the big oil and gas and energy major. A lot of interesting detail coming through in the Shell report today, but the market really trading around those record profits and another big buyback from a business that is really throwing off cash right now. Vestas is up by 12.6%. And Kailey, this goes right back to a US story. This goes back to one of the headline stories we talked about earlier, and that is to do with that that bill passing in the US, in Washington, around climate, and that is lifting energy businesses in the renewable space like Vestas, which makes wind turbines. It's lifting them, and also solar power businesses here in Europe.
Yeah, and you're seeing the same thing reflected in some of those U.S. names in the pre-market trade. We'll have more on that in just a couple of minutes. But first, let's take a look at what is ahead today. President Joe Biden will be speaking with Chinese leader Xi Jinping amid fresh tensions over Taiwan and question marks around whether or not House Speaker Nancy Pelosi will be making a trip there next month. Then the tech earnings continue with Apple and Amazon both reporting after the bell. Plus, we'll get some U.S. GDP data at 8:30 a.m. New York time. This one is going to be closely watched, including by Treasury Secretary Janet Yellen, who will be speaking later this afternoon to discuss the state of the economy. Creedy.
Well, speaking of the state of the economy, we're just coming off of the heels of yet another historic Federal Reserve decision. The Fed has delivered the widely anticipated 75 basis point rate hike and signaled hikes will continue until inflation is clearly heading back down. In a news conference after the decision, Chair Powell discussed the rate path moving forward.
As it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Well, Bloomberg's Michael McKee is back with us in New York from Washington yesterday, where, of course, he was covering the Federal Reserve live. Let's start with the forward guidance. We didn't get any, and they've completely discontinued it. How consequential is that?
Well, it could be a trigger for volatility going forward. Now, the Fed, once we start trading the Fed funds rate at the new level today when the Fed steps in, we're going to see them just below the neutral rate. And if they did 75, it would take them into restrictive territory. So the question is, how badly do they think the economy needs that? And we won't know because there's an awful lot of data yet to come out. And you tied sort of the two together. Today, GDP is going to be very important, not for the overall number. It'll get a lot of publicity out there, but for the underlying data about consumer spending, business investment, whether the economy is slowing. And then we get the income and spending and the Fed's favorite indicator of inflation, PCE, tomorrow. And once they go through all those, they'll have a better idea. They would like to have known all those numbers before they made their decisions yesterday.
Yeah, of course, the Fed had to go first when really it probably would like to have gone at the end of this week. But on that GDP data at 8:30 a.m. Eastern time, technical recession, Mike? I mean, are we still hampering down with those definitions?
Everybody is asking me that question. It's a subject of great debate. It's a Wall Street thing and a newspaper kind of thing. It's not an economics thing because we don't know exactly where the data are going to end up. First quarter was negative in this country, but the first quarter gross domestic income was positive, and there's two sides of the same coin. So something's got to change, and there's a feeling that maybe Q1 gets revised up to a positive number. And then we did see some good news yesterday in economic data that suggests maybe the second quarter will be positive, and then it doesn't become an issue. Janet Yellen set out to defend the administration, may not have to.
Okay, Michael, thank you very much. Michael McKee there. A Wall Street and a newspaper thing, he says. Maybe it'll become a political thing, and that's why we hear from Janet Yellen later on. Now, on to tech earnings, and Meta, the social media giant that includes Facebook and Instagram, reported its first ever quarterly sales decline. CEO Mark Zuckerberg spoke in the earnings call yesterday.
We seem to have entered an economic downturn that will have a broad impact on the digital advertising business. And it's always hard to predict how deep or how long these cycles will be, but I'd say that the situation seems worse than it did a quarter ago.
That was Mark Zuckerberg, of course. Matt Bloxham, Bloomberg intelligence analyst, joins us now. So Mark Zuckerberg, quite convinced, good morning to you, Matt, quite convinced then that this is all part of a broad downturn in advertising. Are you convinced by that argument?
Not yet. I think their issue is more about shifting ad budgets away from the Meta platforms rather than shrinking. I think the shrinking will come, but it's more about things like the ad tracking shifts that Apple made, which has really hit Facebook hard, and also TikTok, which is really eating into Instagram's traditional dominance with consumers. So I think those are more the issues right now. But I do agree that, that there are bigger headwinds to come for the advertising industry.
Well, Matt, let's push this ahead to what we're going to hear after the closing bells today. Amazon, Apple, these massive macro proxies that are, of course, going to be reporting. What can we expect? What are the triggers here for perhaps another overreaction to the downside?
Yeah, so I think Apple's kind of two stories really there. There's the products, which is about 3/4 of the revenue, iPhone, iPad, which are probably going to shrink, partly for currency headwinds, partly for difficult comps last year, and just slowing spend by consumers on those high-end devices. But then you've got the services business, about 1/4 of the revenues, which is still growing strongly. So that's Apple TV, iCloud Music. So overall, probably flat revenues, maybe slight growth, but very contrasting stories. Amazon, e-commerce headwinds, but growth from cloud and also growth from that advertising business, which overall should, put them in good shape.
All right, Matt Bloxham of Bloomberg Intelligence, thank you so much. A casual 10% of the S&P 500 in just those two companies reporting after the bell today. Now let's turn to Washington. There is a deal that breaks the long deadlock on major parts of President Biden's economic agenda. Democratic Senator Joe Manchin of West Virginia and Senate Majority Leader Chuck Schumer have agreed on a tax, energy, and climate bill. Bloomberg government's reporter Jack Fitzpatrick has the details for us. All right, Jack, what's in this thing?
So this goes beyond what we expected. For a little while, it looked like they were just going to try to do essentially a prescription drug measure with a little bit of other health-related issues in there. And then the big news late yesterday was the agreement to add a 15% corporate minimum tax rate, a couple other tax measures, including trying to close the carried interest loophole, and then spend $369 billion on climate and energy measures. Now, this being a Joe Manchin deal, it also includes a measure saying that some of the spending and tax measures for clean energy would be tied to continuing to have oil and gas leases on federal land. So this is the Joe Manchin, much more of an all of the above energy policy kind of measure than your Bernie Sanders proposals. So we'll have to see if Sanders is on board, the progressives are on board. We'll have to see if Kyrsten Sinema gets on board. She didn't necessarily check all of the boxes of this when she talked about the tax measures that she would propose, but it is really a big deal to hear Manchin and Schumer have an outline and actually bill text saying that they have a deal that takes them a big step forward to trying to get this to become law.
And if the response we're seeing in solar and wind businesses here in Europe is anything to go by, this has been a bit of a surprise to the market, so certainly something we'll keep an eye on. Meanwhile, President Biden is set to speak with China's Xi Jinping today. What should we expect from that exchange?
Well, for one, the potential trip by Speaker Nancy Pelosi to Taiwan could come up. That's an issue that has raised tensions very significantly, with warnings coming from China on that. Also, the possibility of discussing lifting tariffs on China is the other main thing to watch for. The White House, when they've talked about this, have downplayed any potential news on something really significant, saying they have a policy of trying to keep the line of communication open with China to avoid any negative surprises. But really, those two main issues of Pelosi potentially visiting Taiwan, which China would not be happy about at all, and the issue of tariffs potentially being lifted are probably the two main things to watch for.
All right, Jack Fitzpatrick of Bloomberg Government, thank you so much for joining us from Washington this morning. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And as Anna and I both mentioned, you are seeing off the back of that news of the climate deal that Joe Manchin and Chuck Schumer have struck, clean energy and solar stocks getting a really nice lift in early hours. Plug Power up about 9 percentage points, First Solar up by more than 7%. And of course, you also have earnings stories out there. One of the more positive ones from after the bell was actually Ford. Profit blowing away expectations. They're really being helped out by higher vehicle prices as well as demand for EVs like that F-150 Lightning. So that stock is up more than 5% before the bell. One more negative story out there, though, is Qualcomm. It, of course, is the biggest chip maker for chips in smartphones, and it gave a weak forecast, citing consumer demand deterioration for mobile devices given the weaker macroeconomic outlook. So that stock down about 4.5% before the bell, Anna.
Yeah, lots of earnings to discuss. It's one of the biggest reporting days of the season, with firms in the US and Europe worth more than $9.4 trillion posting results today. Big tech, big oil and big autos are all in the mix. Later this hour, the chief executive of Stellantis from the auto sector joins us for an exclusive interview. The dollar is on a tear that has few parallels in modern history. Today's Big Take examines how its ascent has left a trail of devastation. You can read all about that in today's Big Take story on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Well, look, we're coming off the heels of a historic rate decision once again, the first back-to-back 75 basis point hikes that we've seen all the way back to the 1980s. But the question is, what's next? And sadly, we don't even have that forward guidance to tell us. But if you look at the pricing here, it's telling us that in our perhaps near, not so distant future, there might actually be rate cuts priced into the market. The question here is, how quickly is the Fed actually willing to pivot and actually willing to slam the brakes? That was one of the main mistakes of the 1970s, this idea that they're going to go tackle inflation head on. They slowed, and then they had to tackle it head on again. Is Chairman Powell going to make the same mistake? Dana El-Batalji, Bloomberg managing editor for credit, joins us now. We thank you as always. Let's put this into perspective. The market is pricing in a little bit of a dovish tilt from the Federal Reserve. The Nasdaq outperforming, the inversion becoming less inverted in the 2s-10s curve. You even have a dollar that actually paired some of that weakness. I'm curious about what you make of that. Is the market getting it right?
I think it's really hard to say if they're getting it right, but I do think that knee-jerk reaction that we saw yesterday was a little bit too optimistic, given the fact that even the Fed has no idea what's going to happen next. But of course, there are lots of investors out there that need to make a quick buck, so I do understand the desire to make a profit. However, the long-term view looks really complicated. And the only thing that I really got from that meeting was inflation comes first and volatility is here to stay. And that is not good news for markets.
After that initial interpretation as dovish, it does seem as if we're having a little bit of a rethink this morning, doesn't it, Donna? At least European equity markets hovering a little. Nasdaq futures down 1%, that in the context of a big rally of 4% yesterday, which I know doesn't undo all of that work. So what data are we now dependent upon? A lot of this data, Fed operations and what the Fed can do operate with a lag. So how do we need to interpret the data given the lag in Fed policy?
Well, I mean, at this point, absolutely every number print will mean something to somebody.
Jobs on Friday, for example.
Jobs on Friday, GDP data, everything from are people paying their rents, what will happen to mortgages, absolutely everything will have an impact. And because we don't have forward guidance, that volatility will be there every single time we get one of those prints.
Okay, Dana, thank you very much. Bloomberg's Dana Baltaji joining us there with the latest on the markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now keeping you up to date with news from around the world, here's the first word. U.S. Secretary of State Antony Blinken plans to speak with his Russian counterpart Sergei Lavrov about a deal to free imprisoned basketball star Brittany Griner and another jailed American. Bloomberg's learned that the U.S. would swap them for a Russian arms dealer it holds. According to Russian media, though, Moscow says there is no agreement yet. SEC Chair Gary Gensler warns that the U.S. and China must reach a deal soon to prevent Chinese companies from being kicked off American exchanges. The dispute has to do with whether American auditors can have access to the work papers of about 200 Chinese companies. If not, those companies could be forced off U.S. exchanges as soon as 2024. On Capitol Hill, the House is expected to approve a bill that includes $52 billion for U.S. semiconductor manufacturers. The Senate passed the measure Wednesday. It's a major legislative victory for President Biden. The U.S. chip industry has steadily lost ground to overseas rivals in recent years. And Ford CEO Jim Farley says the automaker has too many employees, but he's not saying how many he plans to get rid of. On an earnings call, Farley made it clear that job cuts are coming. Earlier, Bloomberg had reported that Ford is planning to slash as many as 8,000 salaried jobs. Farley wants to cut $3 billion in costs to help finance the shift to electric vehicles. And Kriti, this is something we're seeing across industries, not necessarily outright layoffs, but hiring freezes across many of the big tech companies. And I expect we're going to be hearing more of that in the coming months.
And it's interesting. There's a big difference between hiring freezes and widespread layoffs. And when we're talking about whether or not we are in a recession, a technical recession or a real one, as Mike McKee would point out, the economists say, one of the recessionary dashboards is, do we actually see those layoffs? So it's almost like we're on the cusp of that meeting that criteria, but we're not quite there yet.
Yeah, absolutely. When the labour market is the only thing that stands really in your way, there's a lot of focus on the labour market. We will continue to focus then, Kailey, on the auto sector a little bit later on. You were mentioning Ford. We'll talk to Stellantis.
Yep, Carlos Tavares is coming up, and we'll also talk the U.S. economy and that labor market. Ryan Wang, the U.S. economist at HSBC, will be joining us for that conversation and reacting to the Fed's 75 basis point hike of yesterday. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fed Chair Jerome Powell signals that more interest rate hikes are on the way, but he's not giving any specific guidance and says the pace of tightening will slow at some point. From big tech to big oil, investors have a lot of earnings reports to consider. Meta disappoints, Shell sets another record, and we'll hear from Apple and Amazon today. And a surprise deal on Capitol Hill. Leading Senate Democrats agree on a tax, energy and climate plan that enacts major parts of President Biden's agenda. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kriti, that post-Fed dovish interpretation of what we heard from Chair Jerome Powell seems to be fading a little bit. Futures pointing lower.
They're pointing lower, and I would say the selling is actually accelerating even just in the last 30 minutes since we did our last market check. If you actually look at futures now, I believe they're down about 0.5%. So there isn't a ton of movement in terms of the upside conviction. But remember, this is kind of normal when you see a NASDAQ that outperformed so much yesterday. I think over 4%, the S&P 500 closing over 2%. It's only natural to pull back some of those gains. So I think that's what you're seeing in futures. And there's really no kind of overriding risk on sentiment that you're seeing, even in the bond market, really unchanged here, 278 on the 10-year. Even if you're looking at the crude market, once again, in a volatility-induced context, a 1.8% gain on NYMEX crude isn't really screaming buy risk at the moment. Bitcoin even up 0.3%, that massive macro risk indicator, Kailey. Once again, it's not screaming risk on. It's higher, but not risk on.
All right, Kriti. Well, of course, in addition to the big macro picture and the Federal Reserve decision, we also continue to have earnings rolling out from big technology companies. We had a number of them after the bell yesterday, including Meta Platforms, which is the operator of Facebook. It reported its first revenue decline on record in terms of revenue growth, and the forecast also disappointed. The company talking about the slowdown we're seeing in ad spending as that economic environment starts to slow, but they're also struggling with competition from TikTok as well as those Apple privacy rule changes. So that stock is down the better part of 6% before the bell. Qualcomm also lowered. The big chip maker for smartphones is warning of demand deterioration because of those same weakening economic forces. So its forecast disappointed. It's down 4.5%. And then another retailer giving a profit warning. Perhaps we shouldn't be surprised after what we've heard from Target and then Walmart earlier this week, but Best Buy cutting its profit outlook, saying that consumer demand for electronics is fading with inflationary pressure. So that stock is down more than 4%. And I wonder, Anna, what the read-through of that will be when Amazon reports after the bell today. Revenue growth is expected to slow to just 6%. How much are they seeing that consumer weakness as well? Ahead of those results, the stock down about 1% before the bell.
Yeah, interesting to see that part of the business and the role it plays in revenues, whereas cloud, the role it plays in profits, of course. Let's check out what's happening on European equity markets then, Kailey. We have European stocks pretty flat now. The point that I was making with Kriti earlier, we've seen a bit of a fade in that positive post-Fed market mentality that we've seen, that dovish interpretation. Seems to be fading just a little bit. There's a really complex picture when it comes to earnings coming through here in Europe, and the geographical picture diverges quite a bit as well. So different European markets heading in different directions today. Net, we are flat. Barclays down by 2.3%. The numbers seem to beat on a number of areas of the business, but it's concern around costs, litigation and conduct costs in particular climbing at that company. Shell up by 1.75%. The second quarter in a row of record profits coming through from this big oil and gas and energy major, and a big buyback as well. And Vestas, we put this in as well because of the perhaps unexpected meeting of the minds between President Biden and Joe Manchin. And so as a result of that, progress on that energy agenda is being priced into markets, and we see wind businesses and solar businesses really surging today, Kailey.
All right, Anna, well, let's get back to the Federal Reserve because Chairman Jerome Powell rejected speculation yesterday that the U.S. economy is in recession, but Scott Minerd of Guggenheim disagrees.
It is really hard to argue that we're not in a recession, given the fact that, for instance, just one indicator, the leading economic indicators have had 4 down prints in a row on a monthly basis. Every time that's ever happened, that is essentially a signal that we are in or we are about to enter a recession.
And investors may get some clarity when the U.S. reports the initial reading of second quarter GDP today at 8:30 a.m. Wall Street time. Ryan Wang, U.S. economist at HSBC, is joining us now for more. So, Ryan, obviously, we didn't get firm forward guidance from Chairman Powell yesterday. They are going to be watching the data like today's GDP print. But just more broadly, as you listen to the chairman, the market perceived it as dovish, everything that he was saying. Was it?
Well, that's right. On the one hand, Chair Powell started his press conference exactly the same way as he did in June, which is to emphasize that the FOMC is committed to controlling inflation. But as the press conference went on, it became increasingly clear that the policymakers are also attentive to the downside growth risks. And it is a complicated economic picture. Last year, we had a very strong year for economic growth, so it's understandable that things are cooling off. I think what the FOMC is most concerned with is making sure that that slowdown doesn't become even more severe than they might anticipate.
So you think he's attentive to the growth risks, and so perhaps that underscores why we saw that dovish interpretation, Ryan. But at the same time, there is a sense also that the market is, Jerome Powell kept referencing the Fed's own estimates, their own guidance around where the terminal rate's going to be, and suggesting that people should look back at the June forecasts. And with that kind of messaging, you could conclude that the market needs to price in more hikes, not fewer.
Well, that's true. Right now, we're in a transition period. What we've seen is a slowing in economic growth, and it seems to be fairly broad-based across a few different sectors. And Chair Powell mentioned a few of these. He talked about weakness in the housing market. He talked about slower growth in consumer spending and the potential that business fixed investment is already declining. But that hasn't translated into a slowdown in the inflation numbers. Now, logically speaking, if we do see economic slowing and if we see some weakness in the labor market, and Chair Powell talked about this as well, that's part of their forecast. After all, that's the intention of tighter monetary policy. Well, it's reasonable to think that that might eventually lead to a cooling off in these price pressures. But we haven't seen that in the data yet. So you can understand why you have to maintain a flexible approach as a policymaker, because once again, the biggest risk is that inflation expectations become unanchored for a long period of time. And in some ways, that could be even worse than the economic slowdown that we're seeing now. Powell went back to
Yeah. I was going to ask, which is the data point then that you're going to be laser focused on? Of course, we know the Fed is laser focused on inflation then, but what is the data? They're data dependent now. We're a little bereft without the guidance we used to get. So which is the data point that really is going to matter to you most?
Well, of course, it's the inflation numbers that you mentioned, but then it's also the whole full spectrum of labor market data. And what's interesting is that even if you only focus on the labor market data right now, they already show a bit of a contradiction. In the US, we have this unusual situation where we have two separate measures of employment. One calculated by asking businesses how many employees are on the payroll, and another by asking households whether or not they're employed. And right now, over the last 3 months, those two measures are showing a bit of a divergence. The so-called household survey has been much closer to unchanged or flat, not really showing any jobs growth over the last 3 months. Chair Powell actually mentioned this in the press conference, so you can tell that the policymakers are laser focused on these divergences in the economic data.
Ryan, the market is also pricing in several rate cuts going into next year. I'm curious, what do you think it's going to take for the Federal Reserve to hit the brakes?
Well, I think the number one focus is still going to be making sure that inflation is moving lower. I don't necessarily think that inflation has to come all the way down to the Fed's 2% target for the Fed to stop raising rates, but we need to see progress in that direction. And so this is why this whole configuration of economic data is so important. We need to look at what's happening with wage growth. Again, we see a divergence in the economic data. The average hourly earnings series have shown a little bit of signs of slowing, but other measures, including the very important employment cost index, has still been running at a high level. So the next reading on that indicator will also be important. Chair Powell mentioned that as well. So if we see that businesses are becoming less confident about the economic outlook, they're slowing down their hiring needs, and that's translating into a deceleration in wage gains across the economy, then the Fed might eventually think about slowing down and eventually stopping its monetary tightening cycle.
But there's other pieces to the equation, too. You have financial conditions that are in restrictive territory. You also have QT in the background. Are you concerned at all about the liquidity picture?
Well, the quantitative tightening process it's really just getting underway, and this came up yesterday as well. Chair Powell talked about this potentially being a 2 to a 2.5 year process, although no decisions on that front have been made. So it's another case of not just watching the economic data, but also watching financial conditions across a broad range of markets. And of course, we know that the financial markets impact the economy through financing channels. So this combination where businesses are becoming a bit more uncertain about what future demand will look like, and then you have financing challenges potentially through what's going on in markets and broader debt and equity financing. This again adds to the challenge in interpreting what's going to happen over the next 12 to 18 months.
Brian, thanks so much for your time. We appreciate it. HSBC's Ryan Wang with us to talk about the US economy. Coming up on the program, an exclusive interview with the chief executive of the automaker Stellantis. We'll talk chip shortages. We'll also talk about the possibility of an energy crunch here in Europe. What does that mean for the business? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, the CEO of Qualcomm. That's on Bloomberg Technology at 5:30 p.m. New York time. This is Bloomberg.
The energy markets are tight and will remain tight and volatile, I think, not only for the remainder of this year, but also well into next year. Where will it go from here? Let's see. But I'm quite optimistic, both on the energy system as well as the global economy.
That was the Shell CEO, Ben van Beurden, speaking earlier on Bloomberg. Shell reported record profit for the second quarter in a row due to high oil and gas prices. He's quite optimistic, he says. Let's check in with another sector. In other earnings news, Stellantis sees its strong earnings continuing into the second half of the year. Stellantis and its peers have bolstered margins by raising prices and selling more high-end models in response to production curbs sparked by chip shortages. I'm pleased to say joining us now is Carlos Tavares, the Stellantis CEO. Carlos, it's a real pleasure to speak to you. Thanks for joining us. You've said today that the chip shortage will continue for the rest of the year. I wonder, have you got any sense of when you will have all the chips you need to make all of the cars that you want to?
Well, thank you, first of all, for inviting me. It's my pleasure to have this discussion with you. On the chip front, what we see is that the situation is improving, but improving very slowly. We see that the production planning is smoother, that there are less last-minute changes in the production planning. And most importantly, what we see is that the number of troublemakers is much more reduced than it was 1 year ago. 1 year ago, we would have 10 troublemakers in terms of supply. Right now, we only have 2. So our forecast is that the situation will continue to improve through 2022, steady but slowly. And eventually it will be fixed by the end of 2023. So it's going to be still a long process, and we'll have to adapt to that. Most probably will be supported by the fact that the consumer electronics market is going down, and that will shift some more production to the automotive side.
Okay, that's an interesting perspective then, Carlos. So give us a little more granular detail on where these troublemakers, where they come from. What is it exactly that drives the delays?
Well, it's very interesting to understand. It's at tier 1 level, tier 1 supplier level, and we see a big competitive gap between those who are now able to control their own supply chain and create the appropriate buffers that protect their customers like us, and those who are still unable to do so. So it's now a very competitive landscape at tier 1 supplier level, where we see big gaps in terms of expertise to control the supply chain. That is going to become very competitive for the tier 1 suppliers, of course. It's going to be also very important for OEMs like us to select the right partners for the future. And as you know well, we are progressing very fast with a 50% sales increase rate on our BEV sales, and we are taking more and more depth in controlling our supply chain, including on raw materials.
Well, Carlos, clearly for some time now, the problem has been on the supply side. I'm wondering if there will soon be a problem on the demand side, because as Anna mentioned, what you're benefiting from is higher prices, focusing on higher end models. As the economy deteriorates and consumers perhaps become more price sensitive, how confident are you in your ability to continue focusing on that?
This is a great macroeconomic question, and I will try to answer in the following way. Yes, the transaction prices have increased significantly as the consequence of the imbalance between the offer and the demand, which is the consequence of the semiconductor supply crisis. On the other hand, we have been suffering from a significant cost inflation coming mostly from energy as a consequence of the Ukraine war in Europe, and a consequence also on raw materials cost inflation, mostly on steel. What we see now is that as some actors are anticipating on the slowdown of the global economy, if not a recession, we see that the price of steel is now going down, which is a good thing to accommodate eventual lower prices moving forward if the semiconductor supply was to normalize. So we see that may happen on one side. On the other side, we also expect that some of the raw materials will cool down and that we will bring the business to the, I would say, the usual point of management that we had on pre-COVID time. So I think the two are going to a certain extent to compensate each other.
Okay, so perhaps become more into balance. You mentioned higher energy prices, and I'm wondering how Stellantis is planning on managing through the energy crunch in Europe and the inevitable secondary effects of that, including a broader economic slowdown.
Indeed, this is a point of attention. Actually, we have by far the largest manufacturing footprint in the European region, by far. And we are very, very limited in Germany, which is going to be the first country to suffer from this energy crisis. We have only 3% of our production made in Germany, as we have plants everywhere in large Europe. So we are very, very much robust against that kind of situation, even though we are now preparing a short-term contingency plan to protect our German plants from that gas supply crisis. But we don't expect that to be a big problem for our company, as we have a very large manufacturing footprint all over Europe, including the southern part of Europe, which is much less affected by the energy supply crunch.
Well, let's go from Europe to China. You had a joint venture in China and have pulled out as to stop producing Jeeps there. I'm curious why.
Very simply because we had a binding MOU with a partner that did not do what he was expected to do against that binding MOU, and as a consequence of that, we considered that it was better to unwind that operation, which, by the way, was a loss-making operation. And therefore, we are going to fix this issue. We have been seeing over the last few years more and more political interference in the world of business in China. And of course, this example is a perfect translation of that situation. So we just took the consequence of having a partner that was not willing to execute what was agreed previously in the written and binding document for that JV to change its shareholding footprint. So a very natural consequence in business. And we are now focused on the highly profitable CBU business that we have in China. We'll continue to address those highly profitable niches of the market. And of course, we are implementing an asset-light strategy because we are also anticipating on geopolitical tensions that could end up with cross sanctions between China and the rest of the world. And we don't want to be a victim of those cross sanctions, as it has been the case for other companies in other regions of the world recently.
Okay, thank you so much, Carlos. A very interesting conversation, covered a lot of ground. Thanks so much for joining us. Carlos Tavares, the Stellantis CEO, joining us there from Paris. Coming up later today, Ford Motors CFO John Lawler. So sticking with the autos theme, that conversation at 10:45, New York time, 3:45 in London. This is Bloomberg.
Very much what the market was looking for. And that's why the market reaction has been muted. I don't think the pivot will occur as soon as some people are hoping for. And if it occurs, there's going to be a lot of questions about, is this the stop-go Fed of the 1970s?
That was Mohamed El-Erian, the Bloomberg opinion columnist and Queen's College of Cambridge president on the Federal Reserve. Now we bring in Tom Keene, who led our Fed coverage yesterday. He joins us now with a single best chart. Tom.
You talked about stop-go. Dr. El-Erian hearkening back to the 1970s. Let's do that. And the memory of the 1970s is Chairman Powell's biggest headache, and that is housing. Housing is a huge part of the American economy. I'm advantaged in that Justin Fox of Bloomberg Opinion has a spectacular must-read housing summary out in the recent weeks. I put it out on Twitter for your review. This is Mr. Powell's chart. This is the headache. This is rental vacancies nationwide, and we truly are back to the 70s, and that's not a good thing. Down we go from 11%, cutting in half vacancies over the last good number of decade, I'll say. And the fear critic is if we break below that to like a 4% vacancy rate nationwide, that is frightening what that will do to rents and what it will do to the measurement of price change.
Well, in talking of the U.S. economy, I noticed a tweet from Senator Bill Cassidy yesterday saying Biden's inflationary American Rescue Plan has become the American Recession Plan, and you're going to speak with him today.
Yeah, we're going to talk to the senator. I'm not sure where we're going to take that. I think we've got to go to the current news, which is the legislation in Washington. But the linkage here of inflation into recession obscures the fact that you can have many flavors of recession. We'll lead with that with Frances Donald here across the show. She's always good on the makeup of GDP, but I really take issue with the recession gloom that's out there. You never know if you're going to have a recession. You never know what flavor it's going to be. It's like Howard Johnson's from years ago, except Kailey, you don't know what Howard
I know
Johnson's.
life is like a box of chocolates. You never know what you're going to get.
Orange
Forrest
roof.
Gump reference. All right, Tom Keene,
Orange
thank you
roof.
so much. Now, as for what else we're watching today, tech earnings for me. Amazon and Apple due after the bell. 10% of the market cap of the S&P 500. Watching for clues on consumer demand and China and inflationary pressures, Creedy.
And at the same time, well, I should say a few hours ahead, we also have that GDP data. Technical recession perhaps on the cards. What does that mean for the bull case for stocks, Anna?
Yeah, absolutely. So a lot to go on the U.S. data front. I'll be watching the Spanish government as it introduces draft plans for a windfall tax on banks and energy companies. This has been floated back on July 12th, but we don't have any details. So we'll watch response, and that market underperforming the rest of Europe. The rest of Europe really pretty flat, actually, today. A mixed picture across European stocks as U.S. futures point lower. NASDAQ futures, though, pulling back from earlier losses, now down by 0.7%. That is it for Early Edition. Surveillance is next. This is Bloomberg.